In the complex world of business and finance, informed decisions are paramount. Due diligence is a critical process that empowers individuals and organizations to make these decisions. It involves a comprehensive investigation and analysis before a commitment is made, whether it's a major business acquisition, a real estate purchase, or a financial investment. Due diligence is essential for mitigating risks. It allows parties to uncover potential pitfalls and make well-informed choices. Imagine you're about to buy a used car. You wouldn't just hand over the money without checking its condition, history, and paperwork, would you? Due diligence is essentially the same concept, but applied to a much broader range of situations. It's about doing your homework to understand the full picture before making a decision. This process involves gathering information, verifying facts, analyzing data, and assessing potential risks. By conducting due diligence, individuals and businesses can avoid costly mistakes and make decisions based on facts rather than assumptions. It's about reducing uncertainty and making sure that what you see is what you get. Whether you're an experienced investor or a first-time homebuyer, understanding and practicing due diligence is crucial for success. In the following sections, we will delve deeper into the origins of due diligence, explore its various applications across different industries, and break down its key components. By the end of this essay, you will have a comprehensive understanding of what due diligence entails and why it's an indispensable tool for making sound decisions.
The term due diligence has its roots in the Latin phrase diligentia quam suis rebus, which roughly translates to the diligence which a good man employs in his own affairs. This concept of carefulness and prudence in managing one's own business has been around for centuries. However, the modern understanding of due diligence as a formal process emerged in the early 20th century, particularly in the United States. The Securities Act of 1933 marked a significant development in the evolution of due diligence. This legislation was enacted in the aftermath of the 1929 stock market crash, which was partly attributed to inadequate disclosure and rampant speculation. The Securities Act introduced the concept of due diligence defense for underwriters, requiring them to conduct reasonable investigations before selling securities to the public. This legal framework established a standard for due diligence in financial markets and paved the way for its broader application in other areas. Over time, the concept expanded beyond securities regulation and became an integral part of business transactions, legal proceedings, and regulatory compliance. Today, due diligence is a well-established practice that extends far beyond its initial focus on financial markets. From its humble beginnings, as a principle of personal responsibility, due diligence has evolved into a comprehensive process that underpins informed decision-making across various fields. It has become an essential tool for managing risks, ensuring compliance, and protecting the interests of all parties involved in a transaction or agreement. As we move forward, the importance of due diligence is only likely to grow in our increasingly complex and interconnected world.
Due diligence is not a one-size-fits-all concept. Its application varies depending on the specific industry and situation. Let's explore some of the key areas where due diligence plays a crucial role. In the world of mergers and acquisitions, due diligence is paramount. Before acquiring another company, a buyer must thoroughly investigate the target company's financials, operations, legal standing, and market position. This process helps the buyer identify any potential risks or liabilities associated with the acquisition and determine a fair purchase price.
Due diligence is also essential in legal transactions, particularly in real estate. When purchasing a property, buyers conduct due diligence to uncover any hidden problems or legal encumbrances that could affect their ownership rights. This includes reviewing title documents, inspecting the property for defects, and researching zoning regulations.
Investors rely heavily on due diligence when evaluating potential investments. Whether it's stocks, bonds, real estate, or any other asset class, investors conduct due diligence to assess the risks and potential returns of an investment opportunity. This involves analyzing financial statements, researching market trends, and understanding the management team behind an investment.
Due diligence plays a vital role in ensuring compliance with laws and regulations. Companies operating in regulated industries such as healthcare, finance, and energy must conduct due diligence to ensure they meet all applicable rules and standards. This includes reviewing internal policies, conducting audits, and staying informed about changes in regulations.
These are just a few examples of how due diligence is applied across different sectors. The specific steps involved may vary, but the underlying principle remains the same: to gather information, assess risks, and make informed decisions.
When we talk about due diligence, it's essential to understand its key components. These components include financial, legal, operational, and environmental aspects. Each of these plays a critical role in ensuring that the process is thorough and all-encompassing.
Due diligence is, honestly, one of the most important steps in mergers and acquisitions. It helps us uncover any potential risks and ensures that we are making a sound investment.
From a legal perspective, due diligence is crucial. It allows us to identify any legal liabilities or compliance issues that could impact the transaction.
Financial due diligence. Well, it involves a deep dive into the financial health of a company. We look at everything from revenue streams to debt levels, ensuring there are no financial red flags.
And of course, regulatory compliance is key. We need to ensure that the company adheres to all relevant regulations and standards to avoid any future legal complications.
By conducting thorough due diligence, businesses can make informed decisions that minimize risks and maximize potential returns. It's about having a complete picture before making any significant commitments. This process, though meticulous, is invaluable in achieving long-term success and stability.